Welcome to the offering webinar for FreeUp Storage Boardwalk Portfolio that consists of 9 self-storage facilities spread across Georgia and Tennessee. Before we get started, I'd like to get our disclaimers out of the way. We're not offering legal advice. Do your own due diligence on the offering, and please read all offering docs in the deal room. Consult your legal and tax team. And lastly, this is just a general overview. For those that would like to log into our dashboard and subscribe, please visit www.spartan-investors.com and click on the investor portal you'll see up here on the top right. And you can either create a username or log in if you already have one. And you'll find the FreeUp Storage Boardwalk Portfolio investment under the Open Investments tab. And this is our deal room right here, where you'll see the financials, the PPM, the operating agreement, etc. And the bottom on the top right of this page allows you to start the subscription process. As a reminder, wiring instructions are also in the deal room on this page. Just please confirm all wires before sending over the phone with the phone number that's now listed inside of the wiring instructions. If you have any questions, please email us at investors@spartan-investors.com, or you can use the Q&A feature on the Zoom or send us a comment as we go along. The opportunity we will be discussing tonight consists of 9 self-storage facilities that are Class A and B grade facilities that are located in prime locations that project cumulatively strong day one cash flow. The portfolio is located in some of the highest population and income growth counties inside of Georgia and Tennessee. And for those familiar with the Spartan portfolio, you know that we currently own 6 facilities in Georgia and 1 in Tennessee that are very complementary to this portfolio. But before we dive into the details, I'd like to give everybody a little bit more background on the team who will be carrying out all aspects of the investment at Spartan. First, I'd like to introduce you to our executive leadership team. Scott Lewis, our CEO. My name is Ryan Gibson, the Chief Investment Officer. And Ben Lapidus, our CFO, who will be speaking tonight with me on the feasibility and financials of the investment. Spartan Investment Group is based in Golden, Colorado, and in 2021 we were recognized by Inc. magazine for the 2nd year in a row as America's fastest growing private company. And this year we were ranked 166. Spartan is the investment group and brands all of its self-storage facilities into the FreeUp Storage national brand, and Spartan is one of the largest owners and operators of storage in the United States, and we ranked 90th in 2020. Spartan is a vertically integrated company, meaning that we handle all aspects of the investment to include the identification and acquisition, debt, capital raises from our individual investors, and has an in-house construction team that builds our storage units and does our improvements. We handle the asset and property management, and all under the FreeUp Storage national brand. Spartan currently operates over 12,000 units, has about 65 full-time employees and growing, $340 million in new assets, $340 million in assets under management, 400 active investors. We've raised about $120 million of private capital to date, and we have 10 projects that have gone full cycle successfully. We've also uploaded our track record in the deal room for your viewing. Spartan is currently operating in 9 states and over 1.5 million square feet of storage, and we currently operate 35 self-storage facilities under the FreeUp Storage national brand. In Georgia alone, we operate 6 facilities and currently have a focus in most of the Boardwalk Portfolio markets. With the acquisition of the Boardwalk Portfolio, we'll actually operate 16 facilities located throughout Tennessee and Georgia. Overall, we love Georgia, and it's a very strong market in general with the 2nd highest net migration in the United States. So to talk about storage, for those that may be new to the asset class, I'd just like to highlight a few reasons why we chose storage at Spartan to focus on and why we choose the southeastern United States. Well, first on the storage side, during the last 2 recessions, self-storage was one of the least foreclosed upon asset classes, and most recently during COVID, storage continued to be a top performing asset class. Specifically, rents across the United States were up over 12% year over year during the pandemic, and specifically in the Atlanta region, rents were up 19% in 1 year during the pandemic. And that's pretty significant. In fact, Atlanta was one of the top performing storage markets during COVID and had the highest increase in year over year rent. Storage typically does well during times of disruption as it's a beneficiary of life events. We benefit from downsizing, relocation, general life events that all create a need for storage. During COVID, we saw a record number of new leases and record rents in the industry. Additionally, 1 in every 10 Americans use a self-storage facility, but this is not a secret anymore. The REITs and large funds are pouring billions of dollars into the space. Specifically, Blackstone, Bill Gates, Public Storage, just to name a few, in the last 12 months. So, kind of getting into why we love the Boardwalk portfolio opportunity is that most facilities are located in markets that we currently have facilities, which allow us to scale efficiencies in. The portfolio boasts a 96% average occupancy, and the markets that we're in average a 99% occupancy. Couple that with the high income and population growth, it provides the opportunity to bring our rents to market, increase NOI, expand the facilities, all driving great value to our passive investors. The facilities also will attract a top buyer because it comprises mostly A and B grade facilities. All of these factors have allowed us to project day one cash flow to our passive investors. Specifically, in year one, we project a 7.4 cash on cash return. Year two is 7%, which is slightly lower due to the projected 18-month interest-only lending terms amortizing. Investors also participate in the sales upside of the project, which would return about $27,771 per $50,000 invested, or about 55.6 return just from the sale. When you combine all the cash flow and sale profits together, a $50K investor is slated to earn an 18.6 projected annualized return, or about a 1.3x multiple. I'd also like to dive into the expected depreciation and what it means for a $50,000 investor. So over the 4 years, an investor expects to earn roughly $14,000 of cash flow. However, because we do bonus depreciation in 2021, it's anticipated to be about $14,000 of depreciation per 50K investor, which shields the profit from taxes. So in years 1, 2, 3, and most, if not all, of year 4, tax liability is shielded. We also love this portfolio because we can expand at 3 locations, and those locations are already 100% occupied, and the market is over 99% occupied in those locations. So overall, we're excited to talk more about the opportunity with you, but at this point, I'm going to turn things over to our Chief Financial Officer, Ben Lapidus, to talk more about the market. Ben, take it away.
Awesome. Thanks, Ryan. Hi, folks. This is Ben Lapidus, CFO of Spartan Investment Group, and we're going to be talking about the feasibility work that the acquisitions team conducted to get excited about this deal. What's important to note is that this is actually 3 separate transactions. Rather, 2 transactions with 3 sellers. The first transaction is a single asset in Fort Valley, Georgia, about 20 minutes west of Warner Robins, Georgia. The other 2 sellers came together to sell their 8 properties collectively as a portfolio. One brought 6 and the other brought 2 assets. All 9 assets are between Chattanooga and Warner Robins. So let's start off by talking about the state of Georgia. Georgia is the 8th most populous state and has seen strong growth as its economy has diversified away from what has historically been an agriculture and textile manufacturing-based economy. It's now home to 17 Fortune 500 company headquarters, and it's received numerous accolades for its pro-business climate. The Atlanta International Airport is the busiest in the world, both in terms of passenger and aircraft traffic. All of this is a direct result of being a high net migration state. In fact, recently, Spartan read a report that Georgia was the 2nd highest net migration state in the United States of America. That came from Marcus and Millichap. And that's following up what was already a strong decade. Between 2010 and 2019, Georgia saw a net migration count of over 400,000 people, representing a nearly 5% increase in the state's population. Diving into the county level data, we have 3 facilities in Macon, which are located in Bibb County. We have 2 facilities near Warner Robins. One is Kathleen in Houston County, and the other is the Fort Valley location in Peach County. And finally, Murrayville is located directly in Hall County, while the Lanega site is located just outside of Hall County. Both Hall and Houston counties are in the top 10% of counties with the highest net migration across the state of Georgia. And again, this is of a state that's got the 2nd highest net migration in the U.S. When we look at income growth, we like to see close to a 1.5% income growth. All of these locations satisfy that requirement within the 10-minute drive time, but 3 locations stand out as tremendous population growth. All 3 Macon facilities in Bibb County, they're projecting to have 12 to 15% population growth. That's 2.7 to 3.2% per year in income growth. That's incredibly strong for what we're used to. And you're seeing this directly impact housing prices in the state of Georgia and in each of these individual counties. Home values in the Macon area have increased by 50% in the last 5 years, with an 18% increase occurring just from August 2020 to August 2021. Despite the strong home price appreciation, Macon remains one of the few affordable cities, actually, in Middle Georgia. So expecting even stronger home value appreciation because of its strong demand and relative affordability. And Macon is an example of everything that's going on in the state of Georgia. With the massive population growth it received over the last 10 years and the even larger population growth it's currently receiving and planning to receive over the next 5 years, home prices are going to continue to skyrocket. More diverse industries are going to come to the Atlanta area. Wages are going to go up, and the purchasing power and price of goods are going to follow. Meanwhile, over in Peach County, which has historically been the largest pecan and peach grower in North America, that's what it's been known for, we took a look at Bluebird Corporation, which employs 2,500 people in the Fort Valley, Georgia area. The Fort Valley location is the only self-storage facility in that area, so we're not concerned about the competitive landscape. We were concerned about its singular economic source, Bluebird Corporation, so we actually underwrote that as a company. Bluebird is the leader in the U.S. school bus market, which has been historically a recession-resistant industry to be in, which complements storage very well. Between 2019 and 2020, when COVID was in full swing, bus unit sales went from 11,000 to 9,000 units, while adjusted EBITDA went from 82 million to 55 million. While that might seem like a big swing, we're just happy to see that in the toughest times, Bluebird Corporation was able to pump out a $55 million EBITDA. Net margin went from 8% to 6%. That might be a 2% decrease, but it's still a 6% surplus, much better than a lot of other industries during the global health crisis. And the 2021 predictions are expected to exceed 2016, 2017, and 2018 numbers. So it's rebounding very quickly. What's more is that it was the first U.S. school bus company to invest in electric vehicles, and its deliveries were up by 250% in 2020. It's expected that nearly all of its sales are going to be electric vehicles by 2030. So a financially strong business operation with a strategically sound financial future. Over in our two properties in the Hall County area, the main population center is Gainesville, Georgia, which is located on the north-northwest periphery of the Atlanta MSA. It's historically been known for its large number of poultry processing plants. It's often been called the poultry capital of the world. It's home to Purdue and Tyson Foods. But it also includes the Northeast Georgia Health System, which employs over 5,000 people, and Fielddale Farms, which employs over 2,400 people. Meanwhile, for our final two properties in the Hickson County area, in and outside of Chattanooga, Hamilton County saw the sixth highest net migration count over the last 10 years in the state of Tennessee out of 95 counties, welcoming over 25,000 people into its county alone. As a result, median home values have increased by over 58% in the last 5 years, with over a 20% increase just from August 2020 to August 2021. Chattanooga is the fourth largest city in Tennessee, and it's become one of the darling secondary markets of Spartan Investment Group's acquisitions criteria. It's very much like Tyler, Texas of Dallas-Fort Worth for folks who are familiar with our past acquisitions. It's a transit hub. It has a diverse and growing mix of manufacturing services, a large financial services industry with 27 major banks, and it's the U.S.'s largest municipally owned fiber optic system. So finally, diving into the specific locations of the 9 assets that we're buying, the average physical occupancy of the 9 locations is over 96%, ranging from 93% to 100%. Meanwhile, the market occupancy for all 9 locations within a 10-minute drive radius is over 98% for each facility, over 99% average. That is incredibly uncommon. We were very shocked to see that. To have a market occupancy that consistently undersupplied is very exciting to Spartan. We know that when we see 99% market occupancy, that the ability to push rents is well beyond what the empirical data can support for the market. Typically, we look at our competitors to determine what our rent should be, and that's how we underwrote this portfolio. But when market occupancy is 99%, we know not only is the current seller doing things wrong, but all of the operators are doing things wrong in the market because they're not pushing their rents high enough. Because Spartan is going to be the most sophisticated operator in each of these 9 locations, we are going to have the highest rents. And consequently, we don't know how far they can go. They can go likely much farther than we've underwritten. The average economic occupancy across all 9 locations is over 76%. That means there's a 20-point swing between economic occupancy and physical occupancy, almost a 30% increase on collections just by increasing the collections of the existing customers without changing any of the facility amenities, without swapping out any of the tenants, without expanding the facility. That means that there is a rich opportunity to add value financially before doing a ton of work to the physical space. The average facility grade is a B+ to an A-. Every single facility is a B grade or better. We're very excited about the asset quality in this portfolio. We identified 6 of the locations as having land that we could expand on geographically, but only 3 that made sense collectively. That's Macon, Boy Scout, and the Fort Valley locations for a total of 40,500 net rentable square feet that were underwritten. Finally, the most exciting stat is that across all 9 locations, there's only 5 competitive REITs Not 5 per location, 5 total. 2 in Middle Valley, 2 in Boy Scout, and 1 in Kathleen. This is important to us because REITs are sophisticated operators. They are tough to compete with. So we like to be in markets that we can be the best operator with the best asset. So having 6 locations where we're either the only meaningful asset or we are the most meaningful operation in the market is validating to our business plan. So for now, I'm going to hand you back over to Ryan, and I'll see you folks again when we get to the financial section.
Thank you, Ben. I'm now going to go through each of the properties in the portfolio and give a high-level overview of the attributes of each facility. First, I'd like to start in Chattanooga, Tennessee. The property, Boy Scout Road, allows the opportunity to expand the existing facility by about 20,000 square feet. The property currently is 100% full, and if you see in the picture here in the back, it has room for expansion on a flat, graded lot that we have matter of right to expand upon. The other property, Middle Valley Road, is just down the street. It also has very good occupancy, and in this facility, we're just going to pave the drive aisles, repaint the buildings, and bring up the facility a full letter grade. Moving down further south to Gainesville, Georgia, there's 2 facilities co-located in the greater area, which is just about northeast of Atlanta. We'll start with the DeLongaga facility, which is mostly 100% full, has a really nice Class A office, and also has great visibility from the main road. There isn't any expansion potential, but there's a very low saturation in this market and high occupancy. The other property in this market, Murrayville, also boasts both climate and non-climate controlled units. It has great occupancy, and again, the market saturation numbers are excellent, and there's very little competition in the area. The next property that we're going to talk about is further south of Atlanta in Macon, Georgia. And Macon in general is a nice area, but these properties are located in the nicest section of Macon. And the first property is, we're going to rebrand to be called FreeUp Storage Macon. This property is right across the street from numerous housing developments, and they recently just built a Publix grocery store, which is a huge attraction to the area. This facility, also you see in the right-hand picture, has vacant room to expand, and we plan to build at least 20,000 square feet, if not more. The other facility that's close by to the Macon property is Brookdale Avenue. This property currently is branded as Vineville, and this property is mostly non-climate controlled storage, mostly occupied, has excellent visibility from the main road, and also has great curb appeal. Continuing over to the last property in Macon, FreeUp Storage Burris Road. This is one of my favorites in the portfolio because it used to be a furniture store that was actually converted into a 100% climate-controlled facility that's now 100% leased. I love the fact that it's a Class A property, and it's also located on a road that has great frontage and over 100,000 drive-by cars a day. Moving even further south to Fort Valley, in the greater Fort Valley area, we have 2 properties down there, and we have room to expand at the Fort Valley facility by over 10,000 square feet. We have low competition in the area, and overall, high occupancy. The other property is arguably one of the nicest properties in the Boardwalk facility, and that's the Kathleen facility. This is a mix of climate and non-climate controlled units. It's a beautiful facility, and it has high occupancy. So now I'm going to quickly address just some of the things that we do to elevate each property to the FreeUp Storage national brand standards. First of all, we rebrand each facility. We increase rents to market. We train our staff to enhance the customer experience. We develop community partnerships to get that local marketing engagement. We develop corporate business relationships, and we add ancillary revenue through tenant insurance and retail sales. So with that, I'm going to turn it back over to Ben to talk about the financials of the investment. Thank you.
Awesome. Thanks for running us through all that, Ryan. All right, folks, we're going to walk through the financial section. But first, I'd love to direct you to the investor deal room where all of the assumptions and hundreds of inputs that drive our underwriting model can be located. You can also see a variety of scenario analyses that can bookend the targeted performance that we're going to be showcasing throughout the rest of this presentation. With all the analysis that we do and the hundreds of inputs that we measure to get an accurate underwriting file, the most meaningful in understanding our business plan is what is driving the rent collections increase over the 5-year target hold period. And there's 3 lines of effort. There's increasing the collections on the existing customers inside the existing space. There's increasing the street rates to what we believe to be market rates based on first-party data collected in our feasibility study. And the 3rd line of effort is expanding the 3 facilities that I previously mentioned, Macon, Boy Scout, and Fort Valley. So let me walk you through each of these 3 lines of effort. The most important one is going to be increasing the collections on the existing customers inside the existing space. That's going to account for over 40% of our revenue increase over the 5-year hold period. Previously, I mentioned that the average market occupancy was 98%, while the average physical occupancy for the subject portfolio was 96%, and the average economic occupancy was 76%. That's a 20-point swing. Just by decreasing delinquencies, by decreasing discounts, by decreasing loss to lease, we'll be able to push our collections by 40%. And that's not assuming that we hit 100% excellence for every single unit every month. We place a 90% maximum economic performance ceiling on our underwriting, which means that we can never collect more than 90% of the measurable gross potential rental income. That's to package in conservatism and eliminate hubris that we'll be able to rent every single unit every single day throughout the year. The second largest line of effort is going to be expanding the 40,500 net rentable square feet we've underwritten at the previously mentioned locations. That's going to account for about a third of the rental income increases. It's going to drive up revenue by about 14%, accounting for that maximum economic performance ceiling. The last item is going to be increasing street rates. Across the entire portfolio, we're going to be averaging an rental rate increase over the first 2 years by 12.5%. That is not our assessment of market rate growth. That's our assessment of achievable rents today. We just know it's going to take some time to get there. Typically, when we see 99% occupancy, we're able to achieve a 15 to 20% collections increase in the first 6 months. But for conservatism's sake, we packaged in a 24-month window to increase our street rates to market rates by 12.5%. So if you understand those 3 lines of effort, you really understand our business plan. That said, there's a future opportunity to reduce our overall operating expenses, mostly in terms of technology and people. The entire industry, as a result of COVID, is moving to a contactless experience. And so publicly traded companies are starting to reduce their payroll expense. I'll point to Public specifically, which reduced its payroll expense by 10% last quarter, despite increasing its square footage under ownership. Spartan has underwritten 8.5 full-time employees for this portfolio. There's 9 locations, and these locations are coupled together geographically in places where we already own assets. So in some cases, we're going to be able to have one person managing multiple locations. And in some of those instances, we might have pre-existing staff at our pre-existing locations that are right around the corner from these facilities that are in the portfolio. So the likelihood that for the next 5 years, we're going to require 8.5 people in excess of the staff we already have on hand is unlikely. However, again, for conservatism's sake, and because we have not yet fully implemented our contactless experience at all the assets that we'd like, we've underwritten for 8.5 people. So that outlines all the operational opportunity. Looking at the risk considerations, the first thing that we look at is property taxes. Has robust experience, understanding the law, measuring like-kind competitive assessment values, and determining what the mill levy rate should be after a reassessment. We know that government agencies are short-staffed and that they're not always able to assess thousands of properties each year with a lot of rigor. So when we receive an assessment, we take a very kind approach and appeal pretty much everything. So we've gotten to know what is a realistic mill levy rate that's achievable after that appeals process each given year. And we run that calculation and place a 20% buffer on that assessment. And that's how we came up with about 133% property tax increase starting around month 15. The second debt consideration is our debt service coverage ratio. Spartan is assuming a 3.75% interest rate with only 18 months of interest only. Typically for portfolios of this size, the lending environment allows for up to 60 months of interest only. But while we have a couple of lenders identified to offer those kind of terms to us, we haven't locked them in, so we wanted to maintain a conservative set of assumptions for our debt. With those assumptions, in the first year when we're paying interest only on our debt service, we're anticipating to have a 2.3x debt service coverage ratio. That's almost double the requirement that most banks have of 1.25 to 1.3x. And that would mean that we are able to cover our debt service by more than doubling that with the net operating income that we have. That leaves a lot of cushion, a lot of room for a financially healthy operation. And in year 2, when we do start to amortize with these assumptions, we have a 1.97x debt service coverage ratio. In fact, the debt service coverage ratio never dips below 1.8, which is more than 50% of what banks typically like to see. So we're excited about the way that this pans out economically from a risk standpoint. At the end of the 5-year period, we determined the value of the property when we exit in 5 years based off of an expanding cap rate. An expanding cap rate means that we're anticipating adverse conditions to the investment marketplace. Internally, our investment thesis is that cap rates will compress. We're expecting a very favorable market for self-storage interest rates and cap rates going forward, but we don't like to count on that. So we do underwrite for expanding cap rates. And while portfolios of this size are trading about 4.5% to 5%, we've underwritten a disposition cap rate of 5.44%, which produces about a $77.5 million value and producing almost $20 million of proceeds at sale. So how does this all boil down in returns for a single investment? For Class A members, a $50,000 investment will earn a 0.14% ownership stake per share purchased. Each share invested is going to enjoy a 7% preferred return, which means that the first 7% on that $50,000 per year goes to each investor before Spartan Investment Group as a sponsor earns any upside. Right out of the gate, we're anticipating that all of the returns are going to exceed the preferred return of 7% from the first year. The average annual yield is 7.5%, with all 5 years performing above 7%. The total return is 93.1%, which annualizes to 18.6%. Our target IRR is 15.6%. So again, our time considered return is 15.6%, while our time agnostic return is 18.6%. That's an equity multiple of 1.93x. And for folks who have more cash to invest, for a minimum investment of $1 million, our Class B investors will own 3.36% of the entity that owns these portfolio of assets for every $1 million invested. If you're doing the math, that's 20 units, but it enjoys a 20% equity kicker, 20% more than if you were to purchase 20 Class A units. It's the same 7% preferred return, so the 20% equity kicker only applies to returns above the 7%. Similar to the Class A returns, all 5 years, we're expected to have distributions in excess of the 7% preferred return, averaging 7.6%. The overall total return is 104.7%, which annualizes to 20.9%. The target IRR is 17.0%, so again, our time-weighted return is 17.0, while our time-agnostic return is 20.9%. And that's an equity multiple of 2.05x. Of course, Spartan does like to look at various scenarios, so when you open our underwriting file in the investor deal room, you'll see that there's a likely and a worst and a best case scenario. And these 3 scenarios are driven by some of the most important variables in the underwriting file, like cap rate, maximum economic performance, lease up, hold period, and a few others. Based on this variation of variables, we have a very high level of confidence that the overall return is going to land between 12.2% and 28.4%. That's a blended Class A and Class B return assumption. And with that, I'll hand it off to Ryan to take us home.
Thank you, Ben. I wanted to thank everybody for watching the webinar, and the next steps are simply to log in and subscribe to the offering. If you need access to the investor dashboard, please reach out to one of us by emailing investors@spartan-investors.com. And from the dashboard, you'll be able to find all the documents pertaining to the offering and have the Start Investment button to subscribe to the investment. We plan to close up this offering by the end of November, early December, and our first projected distribution for the investment would likely be not until March or April of 2022. We do our investments monthly, and we do have bonus depreciation for this investment that we're planning in the tax year 2021. But we have our executive team here on the webinar tonight, and we're going to go ahead and take live questions. If you have any questions whatsoever, please put them in the Q&A window or send us a comment. Thank you.
Okay, great. Okay. So, but for the folks that maybe just dialed in or they weren't watching on the screen, the loan terms that is projected for the property, and these aren't locked in yet or final. They're usually not final for about a week or so prior to closing, is the 3.75% interest rate, 18 months of interest only, and we plan to have that loan amortize over 25 years. Are the projected returns after all fees, acquisitions, construction, project management have been taken out? Yes, all the projections that you see are net of all fees on the project. Do you plan to refinance after 18 months? No, the plan is not to refinance. That would be an option, that it's covered in the waterfall. However, our plan is to let the loan amortize, and that's how it's been underwritten in the projections. Do investors need to pay state income tax for both Tennessee and Georgia? I think the answer is no, but I always consult with your CPA, because I am not a CPA, and neither is anybody on this call or any of the moderators at this point. I assume bonus depreciation is applied against passive income, not ordinary income. Can you comment? That actually depends on your personal tax situation. I won't get into that on this call, but generally that is correct. But if you're an active real estate professional, that can be applied against your active income. Consult with your CPA. 70% economic occupancy. What are the strategies to improve collections? This question came a little bit early in the call, but generally what we do is we add ancillary revenue, we train our staff, we increase the visibility of the facility through better marketing and branding, and the break-even occupancy is about 66%. Are you removing the revenue share coming in from the parking units, and where are you expanding? We covered that in the webinar. Boy Scout Road, which is in Chattanooga, is 20,000 square feet. We're expanding at the Macon facility, and we're also expanding at the Fort Valley, Georgia facility. And some of the parking units will be removed during the expansion. However, that's been accounted for in the underwriting file. Are there any municipality regulations that will overcome the expansion to take place? There's always a municipality involved in an expansion or any type of permit approval or property inspection. But we do have matter of right to do the expansions. However, we will have to work within the municipalities to get our building permits approved. How many of the current tenants are storing inventory as opposed to individual tenants? We don't have the exact number, but usually it's 30% businesses and generally 70% regular retail consumers. Is the 7% yield available now for an investment? And when do you expect to close on all 9 locations? We were actually supposed to close on Fort Valley today. So the way the PPM is written, as soon as a project, one of the facilities is closed, you will start accruing a preferred return so long as you funded the investment. So I think Fort Valley will probably close tomorrow. Worst case scenario, it might close early next week, maybe Monday. And so anybody who sent in funds actually starts accruing the pref of 7%. That's unique to our deals because typically we have to wait, a couple of months or a month or a few weeks after you funded to start accruing the pref. In this case, it's different because if you fund right away, you start accruing that 7% preferred return. The webcast will be available on demand later. We put it on our YouTube channel. We also will upload it into the deal room and we'll also email it out to our entire investor network. What is our projected build cost per square foot on the expansions? So if you look at the underwriting file and the sources and uses, we've budgeted $3.2 million for the expansions, and that's roughly $60 to $62 a square foot. That $3.2 million number does include contingencies. For ease of confusion, we just ask our construction team to build in a contingency and any overages into that final number.
I was going to clarify, we actually underwrote for $65 a foot in this instance.
Okay, $65. Yeah. Okay. Well, it's going up. The cost of metal is going up. We built a similar vintage facility down in Texas about a year ago, and we built it for $42 a square foot. So as you can imagine, we're building the same vintage and we're budgeting 65. So unfortunately, costs have gone up. How many investment opportunities do you project to be available over the next 12 months? And we are doing about, Spartan this year will close a facility just about every week, but we'll probably have a new investment opportunity in the coming year about every month is our expectation. We're looking at about $10 million of equity need per month for the foreseeable future as we build $1 billion portfolio. Thank you. I understand the pref accrues on funding, but when does the 7% start paying? We expect that to be in March or April of 2022. After we've closed all the facilities, usually a month goes by, and then the month after that month, we do a first distribution. The expansion is going to be mostly climate controlled. That's a good question. And then we have some open questions, and maybe I'll let somebody else answer the questions, but I just wanted to run through the ones that we had for those that listen to the webinar after it's been recorded and can't see the Q&A screen. Ben, I'm going to go ahead and give this one over to you. What is the waterfall upon disposition? That is, what percentage of the sale goes to the investors versus how much goes to Spartan?
Sure. So the waterfall for disposition starts with paying down the accrued preferred return. Our preferred return is rolling. So if we don't hit it for some reason in the first year, which I do believe we are going to, then it would accrue whatever the deficiency was in year one will be added to year two. So if there's any balance left over at the liquidity event, whether it's a refinance or disposition, then we will pay that balance down to zero. The second step in the waterfall is that we will reduce the capital accounts down to zero. So if you made a $50,000 investment and no liquidity events have occurred in the past, then we will pay that $50,000 balance down to zero. That balance does not get altered by payment of preferred returns. It stays at $50,000 until we have a liquidity event. The third piece is after that capital account has been reduced down to zero is to split the upside based on ownership. So it depends on how much Class A versus Class B investment we get. But if we have 100% Class A investment, the split will be about 55-45, 45 to the sponsor, Spartan Investment Group. If we have 100% Class B investment, the split will be approximately 66-34, with 34 going to the sponsor, Spartan Investment Group. It's likely going to be somewhere between those two.
Okay, great. The next question relates to construction. And I don't know, Scott, if you want to take this one, but pretty straightforward question. How easy is it to obtain anticipated building permits necessary for the expansion at each location?
There's many a developer that thought one was going to be easy, only to be thwarted by a new person coming in. This is really, really difficult to answer here because there's so many different parts of the operating environment that can influence that. Being the fact that it's matter of right automatically gives us the opportunity to build there, so we don't have to get permission. But just getting through that process is always kind of a pirouette dance through a number of different stakeholders. So we believe, kind of given the fact that we have matter of right and that we're operating in Georgia, that we'll be able to get through it relatively easily. But again, it can be dicey at any particular time. So I wouldn't want to overpromise here.
Yeah. Typically, there's kind of 3 stages of development. There's entitlement, right, where you have to actually get the land entitled. You might have to take it through a site plan approval process, or there could be a rezone even. But in this case, we're just going for building permits, which typically is just code compliance. Okay, what is the thought behind the interest-only loan for the first 18 months? Yeah, so the thought is that we would love to have an interest-only loan for 18 months, and that way it increases our cash flow. And then after interest only, it amortizes. And then you'll be paying principal and interest on a 25-year amortization schedule for the remainder of the investment. Ben, do you have anything to add to that?
Yeah, just the phrasing of the question makes me believe that the person asking thinks that there's 2 separate loans, and we're anticipating a single loan. There's just an interest-only period up front. And so we try to maximize that interest-only period in the negotiation with a lender because it increases cash flow. But we're anticipating one loan. We're not suggesting that there's going to be a refinance at the same loan balance with a second lender.
Sure. And then the question is, do you get a K1 or a 1099 in March? And the answer is yes. We send out all of our K1s in March, and there won't be any 1099s in this one because there's no interest payment. It's just an equity investment. Okay. When do we plan to finish the expansion? The first 2 years, no construction loan required, correct? Ben, you want to take that one? I believe we have the expansions delivering in month 19, if I'm reading the underwriting file correctly.
You have that exactly right.
And then the
And
construction
that is an
loan,
average weighted assumption. So obviously not all expansions will deliver at the same time. So for underwriting purposes, we have estimated the average weighted delivery date to be month 19.
yeah, and this type of facility takes 3 to 6 months to build. It's not a very complicated expansion. However, we just give ourselves tons of time to do it, permitting, etc., with the city. When do you plan? I'm sorry. What was the? Let's see. I typed one live here. Is this portfolio purchased at the same time or different timing, like DFW portfolio? We do plan to purchase the Fort Valley property tomorrow, as early as tomorrow, as late as Monday, and then the remaining properties will close in December, ideally before the holiday season. Okay, great questions. During amortization, the interest rate stays the same at 3.75%. When does the loan term end at 5 or 10 years? The projected loan term will stay at 3.75% when it amortizes, and it's a 5-year term, just like all of our other investments. If you do a refi and return of capital to investors at the final sale, how do you calculate the split to investors? Is it based on the original investment or the reduced investment amount? So there's a few things packaged into that question. I'll go ahead and just unpack it. If we do a refinance during the course of the investment and your preferred return account balance is paid down, meaning there's no pref accrual, then the capital, any additional proceeds from the refinance or cash event will pay down your capital account balance, and your ownership will remain unchanged. However, your capital account balance accrual or your capital account balance will be lower. So your pref accrual will accrue on what's based on your capital account balance. So but your ownership percentage does not change. I hope I answered that as succinctly as I could. So, okay. What is the biggest risk in the storage space industry and these types of investments? Ben, Scott, you want to take that one?
So my perception of the biggest risk in commercial real estate in general is inflation and interest rates. So just being able to predict what's going to happen with interest rates going forward, especially under the premise of floating rate loans, or how it will affect terminal values. Our internal thesis is a couple of things. One, we underwrite for expanding cap rates, which is a direct result of interest rates. So by underwriting for expanding cap rates, we're assuming interest rates will rise, and the next seller will be subject to a higher cap rate, a better price relative to the NOI, the net operating income we're able to produce. So that's number one. Number two is, despite underwriting for that, our internal thesis is that cap rates will actually compress regardless of interest rates increasing. We have seen some of the benchmarks increasing 20, 30 basis points already in the last 2 quarters as a result of some of the Fed moves or discussions on inflation. But our perception of the tens of billions of institutional equity that have been entered into the self-storage space in the last year that has not found a home is that people are going to be looking for lower spreads between interest rates and cap rates. So even if interest rates go up, it doesn't necessarily mean that cap rates will go up. So the third component is that when interest rates do rise, it's typically coupled with inflation. And so while there might be movement on loans that makes debt service more expensive for either ourselves under a refi scenario or the next buyer under disposition scenario, because we have a product that's based on month-to-month leases, if inflation is increasing, so is the cost of goods and services, which means that ultimately our rents will also increase. Wages typically lag behind that, but wages will follow to account for the fact that things are more expensive. So what we typically see is that there's about a 12-month lag between inflation pushing interest rates and inflation pushing pricing. So even if interest rates do go up, as long as we're able to maintain ownership of our property with a very healthy debt service coverage ratio under our current assumptions, ultimately rents will follow as that lags behind inflation. Hopefully that answers the question.
I'll take it from an operational perspective. The biggest risk to storage is overbuilding. As we talked, as Ryan just mentioned, it takes 3 to 6 months to build one of these things. So the construction is relatively simple. It really doesn't take that much special skill. So that's the number one risk to storage. I'll kind of hedge my bet a little bit on that risk, is that storage is an incredibly local business. Almost, in an urban area, it can be down to a half a mile radius, to a larger rural area, to a 3 mile, 5 mile, 7 mile radius. So I think there's still quite a bit of runway to go here. And when we're looking at occupancies in the 96, 99, 91, and lease ups that are projected to take 4 years, that are taking a year and a half, 1 year, we still see that there's a lot of pent up demand, because through the last building cycle, call it the last 10 years, there wasn't a ton built at storage based on the pent up demand. So while yes, that's the number one risk, we believe that it's actually a lower risk based on the incredible local locality of these storage facilities.
Great. We're going to go ahead and just cover the fees really quick that Spartan charges. Ben, do you want to take the fee question? Just
Sure.
Talk about the reoccurring fees and the one-time fee.
Yeah, so there's 2 types of fees that Spartan charges. One is our sponsor side fees, and the other is our servicing fees when they're in lieu of a third party being present charging those fees. On the sponsor fee side, there's 2. One is our acquisition fee, which is 2.85% of total project cost, paid one time at the closing. The second is a developer fee for orchestrating the development of improvements and expansions, or ground up in other instances. That's up to 10% of the total expansion improvement construction costs, both horizontal and vertical. That's the sponsor fees. On the servicing side, our property management fees are 6% of gross operating income. We don't pass through any additional expenses on top of that other than our travel costs. So 6% of gross operating income for property management. We charge 0.25 point on total project cost per year for an asset management fee. Again, in lieu of an asset manager being present. We charge up to 10% construction management fee on construction costs, and that gets paid to our in-house construction company, once again, in lieu of a third-party general contractor being present. We charge a 2% listing fee if we act as the sales broker. It's not something we've done before, but just maintaining that in case of that edge case where we do feel like it's appropriate to be the listing broker. And lastly, we have up to a 1% financing fee, regardless of recourse or not. Again, if we're acting as the debt broker in lieu of a third-party debt broker being present.
Great, thank you, Ben. And can we speak, Ben, to the delinquency rate now and the delinquency rate that you project in the underwriting?
We don't have the delinquency numbers in front of me, unfortunately, but I can. I mean, we've talked about the economic occupancy is currently 78%. The majority of that is delinquency. There's not too much physical vacancy happening right now. and this seller doesn't have really discount, like a loss to lease line item. There's just a kind of a cadence of different rates over the last 10, 15 years that have come up. So we're at 78% economic occupancy. We place a maximum economic performance of about 90.5%. So there's about 12% of movement that we can achieve on the existing supply. So we anticipate, and usually we perform above that 90.5 economic ceiling, but that's how we underwrite. We're looking at a 12-point swing between current economic occupancy and future economic occupancy.
I could talk about future delinquency from an operational perspective. We try to keep our delinquencies to hover right around 5%, no more than 5%. Of course, some facilities, when we take them over, when you look at a mom and pop operator, delinquencies can come in the form of a number of different things, from bad tenants to bad operators, and they don't have something as simple as online payment. We took over one property and it had a lot of delinquencies, and all we did was put a mailbox on the door, and people dropped off checks and delinquencies dropped. So it had nothing to do with the tenants themselves. It had everything to do with the operator. So going in delinquency, we pay a little bit of attention to that, but we know we're better operators, and some of these facilities don't even have something as simple as online rentals and payment. So just doing something as simple as that can really, really drop your delinquencies.
Somebody asked about our track record of current and past performing deals, and I just wanted to let everybody know that it's available in the deal room. It's called Track Record, Spartan Investment Group. It gives you all of our disposed of assets that have gone full cycle, and it gives you all of our current performance across our entire portfolio on a month by month basis, so you can see exactly how our assets are performing. If you want a copy of that, you can also email investors@spartan-investors.com, but I encourage you to use the portal to find it. We are out of questions. Great questions tonight. Let's do a final call for questions.
Hey, Ryan, give the chat a sniff.
Oops. Okay. All right. Would you take an equity investment in late December? So my response to that was investments are taken on a first come, first served basis based on when funds are received. And if there is availability at that time, we would accept the investment. But I just don't want to say yes, and then it fills up and then you don't have that ability. So I don't want to disappoint you. Delinquency rate, we covered that.
That was it, Ryan.
Okay. Final call for questions, everybody. You can always reach out. Okay. As I understand, listening to Toby Mathis, he says, if Spartan does a composite return, then state taxes are taken care of with that composite return and not passed down via K1. Do you know if Spartan does a composite tax return? Man, I don't know. I don't know. Ben, do you know?
We can ask Toby's partner, Clint. We'll have to ask him tomorrow.
Yep. We can get back to you if you want to email us. It says anonymous attendee, so I can't see who you are, but if you want to email us, we'll get back to you on that answer. And if anybody else wants that answer, shoot us an email and we'll send it back to everybody. Thank you, Kevin. Appreciate the kind words. With that, we're going to wrap things up. We wanted to thank everybody for considering this investment, and we hope to work with everybody in the future. Thanks, everybody, and have a great night.